Good morning, America. Hope you're doing well. I think this is quite a good follow-up to the video I did a few days ago about being shaken out of the markets. The NASDAQ is down 4.5%, as is the S&P, down 2.5%. Meme ETFs nuked. Quantum and data center names are down 40 to 60% from their all-time highs. Bitcoin is smacked, down 23% since its all-time high. We finally get past the longest shutdown in history, we avoid a crisis, and the market's response is to absolutely faceplant. I'm calling it one of the dumbest sell-offs in years. In this video, I'm going to walk through a few things. First, we're going to go through what actually triggered this move, why AI and growth got smoked, what the bears are actually right about, and why I'm using this to start scaling into positions instead of panic selling when everyone else is. In this video, I'm going to walk through what actually triggered this move, why AI and growth got smoked, what the bears are actually right about, and why I'm using this to start scaling into positions instead of panic selling. So the US government just came out of a 43-day shutdown. During that time, we got no official macro data, no CPI, no unemployment, no retail sales, no GDP. Markets quietly drifted up to highs because there was literally nothing official to contradict the soft landing narrative. Shutdown logic was simple. No news equals no bad news, basically. Then the government reopens and boom, the sell-offs that you're looking at now. And why is that? Because reopening doesn't just mean, yay, we're back to normal. It means there's a wall of delayed data about to hit. September and October jobs, inflation, growth, it's all coming. And there's a real chance of some of that data being messy, compromised, or actually never being fully released. The markets hate one thing more than bad news, and that's uncertainty. So you get a sell the news event on the reopenings, plus fears about the backlog of data and what it's going to show. Layer number two is the Fed. A month ago, markets were pricing in a 96% chance of a rate cut in December. After the shutdown and after the data blackout, the odds have collapsed to roughly 50-50. Remember, so much of this year's rally has been built on two pillars: AI miracle growth, and two, don't worry, the Fed is going to start cutting soon. Now, suddenly pillar two is wobbling. The Fed doesn't have clean data. They can't credibly say, inflation's fine, labor market's fine, let's cut. So the markets have to reprice all of that optimism they've been front running since the summer. That's why you're seeing the VIX spike and options implying December the 10th will be the most volatile day for the rest of the year. And finally, of course, a lot of leveraged, easy Fed trades being unwound in a hurry. So this sell-off is actually quite leveraged. So this is not just about everyone woke up and decided AI doesn't work. A lot of this move is forcefully leveraging. I watched a really interesting video on leverage earlier today. I advise you to go check out Meet Kevin. I'm sure you already watch him every day anyway. But he made a really interesting point here of the FINRA margin data. And basically FINRA debt today is about 26 higher than it was at the 2021 peak. Cash in brokerage accounts is about 21% lower than at the peak. In previous cycles, when margin went up, cash also went up. People took out leverage, but they also still had a buffer. This time, margin's up and cash is down. Everyone went all in on AI tech, the crypto story with not much cushion. Robinhood margin borrowing is well up over 100% this year. So when, firstly, the shutdown ends, two, the data is missing or compromised, and three, Fed cut odds get slashed, the wall of leverage starts to crack a little bit. And so here we're looking at perhaps a bit of a liquidation event as well. That's why the meme ETF is down over 40% in the month. Post-revenue quantum names and speculative data center stocks are down 40 to 60%. And Bitcoin, high beta growth, all puke simultaneously. Now let's talk about the story everyone's focused on, AI. One study on the first half of 2025 GDP literally found out that around 90%, 92% of growth came from the AI CapEx build-out. Earnings growth, same idea. AI, data centers, and cloud have been the main thing holding up the whole economy, basically. So when AI stocks drop, it feels like the entire macro regime is breaking. And to add to that, headlines about Microburry shorting Nvidia and Palantir, even though the real position is tiny compared to how big it really was. People are questioning, we're over building data centers and power infrastructure and the phantom data center risks. Mega cap throwing tens of billions at AI with slightly PTSD-inducing memories of Meta's metaverse binge, if you remember that. And there's quite a lot of inside selling as well on some of these hot AI proxies. It's no surprise that fear and greed index is back to extreme fear. An AI sentiment survey shows that 49% are bears versus 31% are bulls. Social media is full of the word AI bubbles, and you look on YouTube, there's so many videos on stock market crash and AI bubbles and stuff like that. So anyway, you've got max leverage, max AI concentration, and max narrative whiplash, and there's a missing data situation and a wobbly Fed on top. Of course, the high beta stuff is going to get obliterated in this situation. So I want to be fair to the bears for a second, because some of the arguments they're making are legit. I've watched a lot of YouTube videos on different bear cases, and some of their arguments are legit. The cautious view is we're probably heading for a modest recession in 2026. AI CapEx and AI hiring has been doing an outsized share of the lifting in the economy. If that slows, the labor market and profits will feel it. Corporate America is gorging on debt. Households and foreign investors have never been this exposed to US investors before. A sharp drawdown in the US economy could trigger a global wealth shock. And there are classic late style signs. But notice the time horizon. A lot of this, I think, is next year's risk, not the system is exploding this week. But I think we need to focus on the timeline here. A lot of this is 2026 risks, not necessarily the system is imploding this week. Today's move is not about a Lehman-style credit freeze or a COVID-style sudden stop. It's about a market that was heavily long, maxed out on all margins, and shocked by a sudden loss of clarity on data and Fed policy. So with all this said, why do I still call this the dumbest sell-off in years? Because when you're looking at the actual data that we do actually have, the picture is very different from the panic in the prices. Corporate earnings are at or near all-time highs. US companies, especially in tech, have record profit margins. Real-time inflation measures are tracking around 2 to 3%, and market inflation expectations are trending down, not blowing out. High-yield credit spreads are around 3%, not pricing in a wave of defaults. The percentage of stocks above their 200-day moving average is still over half, which isn't necessarily meaning the markets are broken. Oil is in a Goldilocks zone, not screaming recession and not crushing consumers. And then there's this chart on the right. World wars, Great Depressions, Black Monday, global financial crisis, COVID. Every generation has a narrative why this time is different, but the line of this chart goes from bottom left to top right. The market climbs the wall of worry every single time. What we're seeing this week is fear, forced deleveraging, and a temporary data blackout, not a structural collapse in profitability or capitalism. That's why I'm perfectly comfortable calling this a dumb sell-off. Not because there's no risk, there are risks, because the magnitude of the price reaction is wildly out of line with what's actually broken right now, which is mostly investors' risk management. So what do you actually do with all this? First, if this week has made you want to vomit your entire portfolio into the air, hear me out. You probably shouldn't necessarily be stock picking. Most people should just buy a broad index ETF and get on with their life. There's no shame in that. But if you're going to pick individual names, then you need to think a little bit like this. You can learn from these issues, and in the future, be more careful with leverage. Don't let broker risk be the thing that ruins you. Secondly, if your portfolio is 90% pre-revenue AI, quantum, or meme names, this is your wake-up call to actually diversify into actual cash-generating businesses. Volatility like this is exactly why I kept roughly 50% in cash coming into this. I wanted a panic like this so I could start scaling into quality names I already like at better prices. I'm not trying to time the bottom here, because remember, the bottom is just another word for ass, and you're going to look like an ass trying to time the bottom. It's about strong fundamental research and technical analysis and scaling in at prices that look attractive to you. So anyway, I don't need the exact bottom. I need the fear, the forced sellers, and a good business getting marked down because people can't manage their margins. Anyway, guys, that's all from me today. Thank you so much for watching the video.